what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas, but you've heard some horror stories about how people buy a house, they get a mortgage, they've got a monthly payment, and all of a sudden a year or two down the road, their payment goes up a ton and they're having trouble making that payment. Well, in this video, I'm going to teach you why that happens, how to avoid it, and if it happens, how to correct it. Stick around. This one's going to be good. So look, when buying a house in the state of Texas, DFW, anywhere, one of the most important things and that people are paying attention to right now is affordability, interest rate, monthly payments, even homeowners insurance obviously right now is extremely high. And so people are having a hard time qualifying and affording the payments, but there are a lot of people out there that still know there's opportunity in the market. They're buying a house, they're getting a discount from the seller, they're getting cheaper rates, they're getting closing costs paid for. But all that being said, at the end of the day, whenever you close on a property, you've got a monthly payment. That monthly payment usually consists of one of three things, sometimes all three things. You'll have the mortgage payment, the principal and interest only. So this is however much you finance, the interest rate over the term. Let's just use round numbers and say the mortgage payment is $2,000. Then you're gonna have your homeowner's insurance, which is the insurance you have on the property. Let's just say that's $300. So now we're at $2,300. Now let's say there's property taxes on that property, and let's just call that $700. So we'll make an easy, clean $3,000, okay? $2,000 for the mortgage, $300 for the homeowner's insurance, $700 for the property taxes. Your total all-in payment is $3,000. Now, what happens is you close on that house, you sign the papers, you get your keys, you're super happy, everyone's ready to go moving forward, and the assumption is your payment's gonna stay like that for the life of the loan. Well, the mortgage payment, the principal and interest, if you're on a fixed mortgage, that will stay like that for the life of the loan. But let's talk about why people get bills in the mail. They get notices in the mail from their mortgage institution a year or two or three down the road that says, hey, your mortgage payment is increasing $200, $300, $500, okay? And then all of a sudden the payment goes from that $3,000 to $3,200 to $3,400. It makes people panic. Sometimes they cannot afford the extra payment and it can put them in a financial burden to where they either have to sell the home or sometimes foreclose on it. So what happens each and every year, the gift and the curse of buying a house is the number one benefit of being a homeowner from a financial standpoint is houses historically appreciated about 5% a year. So for an example, if you buy a $500,000 house, it appreciates at 5% a year. That would be $25,000 each and every year would go up after the fact. There's a lot of money to be made there because the secret of real estate is not wait to buy, it's buy and wait. And over a long period of time, that appreciation can make you wealthy. However, property taxes that you pay the city, the county, it's based on the value of the house. So when you close on that $500,000 house, the day of closing, and your property taxes are $700, that is the number they use for property taxes at that time. So that's what's in the bottom line for the payment for the taxes. But it doesn't stay that way because if your house the next year is worth $525,000, that's $700 a month might be $730 a month. So there's a $30 increase there. Now the same concept applies for homeowners insurance. Your homeowner's insurance was $300 a month, but that was to replace a house that cost $500,000. Now your house is worth $525,000. So your homeowner's insurance might go up from $300 a month, let's say, to maybe $310. So now you've got $30 extra on the property taxes and you've got $10 extra on the insurance. That's $40 a month. You take that over a year, that's obviously almost $500. So I want people to understand how and why that happens. And so mortgage companies by design, if your taxes and insurance are set up in your payment, they set up an escrow account at closing. It's a slush fund, but they'll pre-collect a couple extra months of taxes, a couple extra months of insurance, and they'll put it in this little placeholder escrow account. And so once you close, if taxes and insurance adjust some up over the next few years, they don't want your payment to adjust. So they'll just take the difference of whatever it is from that escrow account over the first year or two and try to make up the difference and say, hey, you know, this thing went up $50. We don't want to adjust your payment. You've got this money you prepaid with us. So we're just going to take it from this tank of gas until it runs out. The problem is that with the way that people have been buying houses and the appreciation rates, specifically in Texas, the house prices are going up and the values are going up so fast that the houses are not going from $500,000 to $525,000. They're going from $500,000 to $550,000, $575,000, $600,000 over a year or two. And what happens is those property taxes are going up quicker than they thought. The escrow money with the lender is running out. And then all of a sudden what happens is the escrow money runs out. There's a shortage of money that they're supposed to pay because obviously they've got taxes that they're paying on a house that they closed at $500,000, where maybe a year and a half, 2 years down the road, it's now $600,000. They've used the money from the lender, and so now there's a shortage. Maybe it's a shortage of $100 a month for property taxes, and maybe it's, $25 a month for homeowners insurance. So the lender, they're required to make sure that those property tax bills and those homeowners insurance bills are paid in full. What happens is they've been collecting a small amount from the consumer. They get the notice from the county, they get the notice from the insurance company that this house has now gone up. The money you've been paying us is no longer enough. We need this much. So what happens is they go back to the consumer and they reanalyze the escrow account and they say, hey guys, we're short. Not only do we owe an extra 100 or 150 a month, right? Moving forward, it's also going to be this amount. So what happens is they got to go pay the arrears, the money that's behind. That was a shortage that they didn't have enough money from. And then they got to set the escrow account for the new $600,000 house for $575, whatever it is. And all of a sudden they try to allocate that and spread that over 12 payments. And you can have that original $3,000 payment go up from, $3,000 to sometimes $3,400 or $3,500. You have this payment spike. And so people freak out. Now, I want to remind everybody, it's normal for your mortgage payments to go up a little bit each year and for the lender to slowly use that escrow account, and it eventually runs out. If you stay in your property for long enough, obviously you're going to have the escrow account run out. What most lenders do is give the consumer a heads up and say, hey, we are now out of money. You've got two choices, right? You can replenish the escrow account and bring that surplus back up, or we can just increase your payments. An extra $200 a month is totally up to you. And again, it's a good thing that your payments are going up slowly over a long period of time, which means your property value is going up. So that $500,000 house, if it's now worth $625, 6 years later, when you go to sell it, you're going to make $125,000. The downside of that is obviously the property taxes are more expensive, the homeowners are more expensive, and every year it continues to climb. And so therefore the coverage on that stuff and the costs are more expensive. Now, if it happens in very small increments, once a year, $100, every other year, $100, $200, it's okay for the consumer because they can absorb that shock. When it happens dramatically, maybe 2x within a 12 to 24 month window, and the bank has to go back and collect, the shortage plus reset everything for the future, this is what causes an issue with the consumer having a payment spike, getting a notice in the mail, and completely freaking out. And when that happens, I hate to say it, you're pretty much stuck. Now, the only way to really get out of that is to either go back to the lender and say, hey, whatever the shortage was, $2,000 or $1,800, you can actually just cut a check to the lender and say, here's the money for the shortage, and then they will take your payments back to what they originally were. But most people don't have that money, or sometimes a lender don't offer it up front. They just assume that people want to end their payment, but you can pay the shortage in full if you have the extra money in the bank. If you don't, obviously you make it in the new payments with the higher amount over a period of time to pay the lender back. The third thing you can do is, if it's worth it, refinance. A lot of people are going to want to refinance in the next probably 6 to 12 months anyways as rates continue to drop. But if you've got this old mortgage payment of $3,000 and a new mortgage payment of $3,500, and you're like, man, I'm just paying all the arrears and everything increased from behind, and my mortgage company did it to me, and so now I'm just going to be stuck here forever. You can refinance the entire note, hopefully get a little cheaper rate, lower the overall payment, and what it does is it resets the escrow account. It takes it back to what it's supposed to be versus the shortage that the lender is charging you, and therefore your monthly payment obviously will be, much cheaper going forward, and all those arrears will be caught up. My suggestion to anybody out there is, if you're buying a house and the loan product will allow for it, I think you should take your taxes and insurance out of the payment, manage your own money, make money on your own money, pay those bills at the end of the year. But again, only if it's an option and only if you're responsible. So I just want to be clear that mortgage payments do go up over a period of time when they're escrowed. This is not necessarily a bad thing. When your house is going up in value, at the end of the day, when you sell it, you'll make money, but you've got to be conscious and aware of the property taxes and the homeowner's insurance increasing along the way. Because if you don't, and things appreciate too quickly, or you don't go with your lender and find a way to make up the shortage, they will force it back into payment. The payment will spike, and obviously sometimes it causes financial hardship for people, and it's hard to get away from, and they need to seek counsel. So if you have any issues like that, feel free to call me. If you don't, just be proactive and aware of it, so that way you don't run into a hardship that causes you or your family any problems. So listen, if you found this video useful, do me a favor, like, comment, subscribe. If you know anybody that's struggling with these hardship payments, feel free to share this video. I know there's a lot of people out there that need some guidance on that. And obviously, if you want to talk with us about anything financially, want to talk about your future home loan journey, buying a house, refinancing a house, do us a favor. Call us, email us, text us. We're always here for you. Until next time, stay tuned.